Yes, hello, everyone. My name is Anthony Froggatt, and I'm a Senior Research Fellow at Chatham House in the Energy Environment Resources Department. I'd like to welcome you all to this annual event, which is called the Forecasting Forum. For the last few years, we've been hosting this around this time of year, so late January, and its purpose has been to discuss the energy sector and what it might hold in the year ahead. Obviously, in the current circumstances, we have changed the format and have opened it up. So normally we have quite small meetings, maybe 30 or 40 people. But moving it online, we've taken the opportunity to open it up to from all over the world. So far, there's around 200 people that are participating in it, and we may well see more coming in throughout the meeting. We've also shortened this and have changed the format. So we'll have shorter presentations from our three speakers and then Q&A from the audience. And the panel this afternoon is Professor Paul Stevens, who is a distinguished fellow here at Chatham House and is also a Professor Emeritus at the University of Dundee. He's also a distinguished fellow at the Institute for Energy Economics in Japan and was a recipient of the 2009 OPEC Award for Services to the International Oil Industry. He also has degrees from Cambridge and the School of Oriental and African Studies. He will be then followed by Amrita Sen, who is co-founder and head of research at Energy Aspects, which is a analyst and forecasting firm, in particular looking at crude and product markets. She holds an MPhil in economics from Cambridge University, a BSc in economics from the University of Warwick, and most recently has become a doctor at the School of Oriental and African Studies in London. She was formerly chief oil analyst at Barclays Capital. And finally, Daniel Quiggin, who is a senior research fellow here at Chatham House. He has experience and expertise in the modeling and analysis and forecasting of national and global energy systems. He's worked for a variety of organizations, including most recently for BEIS, as a senior government advisor on energy and Brexit, and previously as an analyst at Investec Asset Management within the Commodities and Resource Investment team. He too holds 2 master's degrees, one in particular physics and climate science, and a PhD in energy system modeling. So as you can see, we've got a very esteemed panel in terms of their academic record. I've asked everyone to keep their comments to around 20 minutes. Each of them has got a PowerPoint that they will share. During this time, we would ask you to use the Q&A function at the bottom of the screen. And then depending on the number of questions, I will either call upon you individually, if you so wish, to take the mic and put forward your question verbally, or I'll group the questions together so that we can have a time to get through a wider number of different questions. There is also a facility in the Q&A function to vote on particular questions. So please do give thumbs up to those questions that you would particularly like to hear answers on, because this will help our prioritization as we come to that part of the session. Kick off and over to you, Paul.
Okay, thanks very much, Anthony. Let me just try and share the screen. I want to talk about several things in my moment of timing. First of all, I want to look at what happened to prices in 2020 and then look at the prospects for 2021. And it will be under 3 headings: demand and supply. And then I'll bring those two together to talk about prices. So what happened in 2020? The market was consistently oversupplied. And as you can see from the diagram, prices collapsed. That's the blue line, the lower blue line, and stocks rose. That's the higher red line. I use US stocks because they at least give some relatively recent numbers. And the advantage of that is that you can see what's happened rather than going back several quarters, which is what most of the other data is on. So I'm using that as a proxy to represent stock levels. The reasons for this were basically two. First of all, obviously, the coronavirus pandemic. That was far worse than expected. If we go back to the sort of first quarter of 2020, I don't think anybody expected it to be as bad as it was. The result was widespread lockdowns and a oil demand collapse. You have to be aware of the numbers here. There's various estimates, but somewhere between the order of 8 to 9 million barrels a day of oil demand were lost last year. Then the next cause of all this was in January, the OPEC Plus agreement collapses, and effectively you have a price war between Saudi Arabia and Russia, and you can see the effects of that on the diagram quite spectacularly. OPEC Plus was restored in May, but it's worth remembering that this was only because President Trump threatened MBS that he would withdraw all US military support for Saudi Arabia unless they got their act together. Next slide, please. Let's look at the demand prospects for 2021. My view is that demand will remain weak. The mutant virus strains will revive lockdowns. Viruses mutate. This should have come as no surprise to anybody. Also, as well, my feeling is that the vaccine rollout will disappoint on a global basis. So the idea that we're all out of the woods because of the vaccine, I think, is not going to happen. At the same time, the global recession is going to be deeper and continue for longer. Several points to make about this, I think. First of all, you need to be very careful of econometric forecasts being used by places like the IMF and other central banks. Econometrics simply cannot deal with major discontinuities because it derives from what's happened in the past. So I think the sort of forecasts we've been seeing should not be taken too seriously. I think, as a good Keynesian, precautionary savings are being significantly understated. In the current economic environment, people are not going to save. They're going to husband their savings to wait to see what happens. There are stimulus packages, of course, but there are limits to this, despite modern monetary theory, which says in these circumstances, governments can print as much money as they want and it doesn't matter. The reason for the limits to that is a political image issue. So people still are geared up to the old idea that if governments print money, it leads to hyperinflation, etc., etc. A third factor is considering changes in behavior, which have reduced oil demand. The question is, are these changes a blip or are they a significant discontinuity? It's worth remembering that travel accounts for 60% of liquids demand, and it's fair enough to ask the question, are there going to be any airlines left to fly on when it's over? There's also the question of changes to working practices. The pandemic has caused a great deal of working from home, and a lot of people have discovered they quite like this. So the idea that you're going to see a resumption of demand for travel in oil in travel is going to be fairly limited. Next slide, please. Let's look at the supply prospects for 2021. I think supply is going to creep up in this year. A couple of points. First of all, Saudi policy is going to be a key uncertainty here. In January, Saudi Arabia dropped a proverbial bombshell and did a dramatic U-turn and explicitly reverted to its swing role by cutting its production unilaterally by 1 million barrels a day. It's interesting to speculate why they did this. My opinion is that it was largely aimed at the speculators. Saudi Arabia has done this quite often in the past 20, 25 years. It's made sudden changes just in order to teach the speculators a lesson. And when Abdulaziz bin Salman, the oil minister, gave the news of this, Somebody was at the press conference, described him and said he gleefully declared and went on to say to the speculators, enjoy your ouching. However, having said that, they desperately need revenue. The 2021 budget was by most observers, optimistic. The reserves in 2014, 354 billion, last year down to 75 billion, and recently they've reverted to international borrowing. Another issue here is OPEC Plus, and in my view, compliance in OPEC Plus will continue to weaken. In December, estimates suggest that compliance was only 75%. And the other members of OPEC Plus, other than Saudi Arabia, they'll look to Riyadh and say to themselves, well, if we cheat a little bit, Saudi Arabia has now reverted to the swing role and they will absorb whatever is taken. So I think from that point of view, the glee will be somewhat short-lived. And Russia will continue to cheat bigly. I couldn't resist that. What about the USA and oil production and the whole issue of Iran and Saudi Arabia? Next slide, please, Anthony. Okay, my view, US production is probably going to increase gradually, but it's going to be slow. It's not going to be a dramatic increase. A big question here is the impact of the Biden administration. And the question arises, what role does the presidency have in influencing domestic oil production? And the slide on the right there is, I find an interesting slide. It compares two presidencies. The presidency of George W. Bush, who was incredibly pro-oil. His vice president was came from Halliburton. He came from Texas. It really was the most pro-oil US administration that's been seen for many years. And then compare that to the Obama administration, which was very much pro-climate change. And you see under Bush, US production fell. Under Obama, it rose dramatically, which says to me that maybe the presidency doesn't have that much influence. A couple of other areas. Biden has said that he wants to revive the JCPOA with Iran. Iran's potential is quite significant. They could increase their exports by around 1.5 million barrels a day in a fairly short space of time if sanctions were off. Now, I actually think that's going to be rather unlikely. There are serious opposition on both sides of the agreement to renewing it. You have the Iranian elections in June, and the hard lines certainly seem to be on the uptake. Also, as well, in terms of Biden's policy, foreign policy is going to be quite low on the agenda. Biden's got an awful lot of domestic issues that he needs to address before going into petrodiplomacy. Attitudes to Saudi Arabia is also going to be important. Biden's on record as being very concerned about human rights, and he actually called MBS a thug, and I quote. Also as well, Saudi Arabia is very unpopular in Washington on both sides of the House. So it could be interesting to see what happens in Washington and how that might affect the behavior of Saudi Arabia. As for the shale sector, again, I think it's going to gradually recover. Yesterday, Biden announced that he actually put into law a ban on new federal land leases. I think it's going to have a limited impact, however. Only 25% of US oil comes from federal lands, and it's not going to have much impact this year. It may have a further impact down the road, but this year is not going to be a great deal of impact. Next slide, please. So how does all this come together to look at prices? I think overall, oversupply in the market will continue, and that will put downward pressure on prices. In the OECD stocks, there has been some recent fall, but they're still historically very high. And on the right-hand side, you can see the US figures for stocks. And although they have been going down recently, they're still, from a historic point of view, very high. The big uncertainty here is non-OECD inventories. And all the evidence suggests these have been climbing significantly during the price collapse of 2020, but there have been problems emerging with missing barrels. There's a very good paper on this by the Oxford Energy Studies group published in December. The higher the price goes above $50, then the faster US production will increase. But more importantly, I think the greater will be OPEC plus non-compliance, pushing supply further. Markets are going to remain nervous and are likely to be volatile, but I find it difficult to see them staying much above $50 a barrel for any period of time this year, and they're going to be very vulnerable to rumours. And at that point, I stop and we'll turn you back to Anthony. Thank you.
Perfect, Paul. Thank you very much indeed. Great timing. Amrita, can I pass straight over to you and remind people to start putting some questions in the Q&A, please?
Yeah, thank you very much. I am going to share my screen. Right, so carrying on from really where Paul left, I'm going to focus on natural gas markets and take you through our views on where we are seeing the market headed. Now, interestingly, very much in line with what Paul said about COVID and the demand recovery, we are very much aligned even at Energy Aspects, both across oil and gas, that we aren't expecting to see a very big increase in demand on the whole this year. Well, even for oil, for instance, we are expecting 5 million barrels per day of increase versus an 8 million barrels per day decline last year. Similarly, for gas, we are going to see industrial demand still suffering, given overall how much we do expect to see a slowdown in economic activity and also to do with just general unemployment. We do think it'll only be 2022 end when both oil and gas demand really goes back to the 2019 levels, not prior to that. However, I think what gas has shown us this year alone is how important Asia is, and despite all the focus on net zero, and I know there will be, and I'll touch upon a bit as well, and kind of gas's role on that. The reality is when it gets cold, gas just remains, it's so important as a heating fuel that we have seen LNG prices hit record high. I don't think anybody would have thought that this could have even happened at a time when gas demand has crashed because of COVID. But of course, what has happened, particularly in Asia, we've seen Japan and Korea with record low stocks. And obviously the weather has then driven utilities there to import huge amounts of LNG. China is a really big one as well. They've come in and bought an enormous amount of LNG, which has then meant that prices are, they've come off a little bit, but they are at a record high, which, again, given the broader context, you could argue that it's quite surprising. However, I think it's worth noting that one of the big things in terms of weather has been just how low inventories have been, and that's kind of exacerbated the increase in gas prices this year. Last year, gas didn't fall by as much as oil did in terms of prices, and a big reason for that is working from home, and Paul alluded to that. The thing about heating is that obviously when people in the summer, when they use their houses, it wasn't really prevalent, but in the winter, especially if it's cold, you get a double whammy because clearly you get a bigger push from the residential heating sector in gas. But equally, even though offices aren't fully functioning, they do need to be open for key workers, even whether it's in the US or in Europe, offices are still being heated, and the same as in Asia. So the gas demand didn't fall by as much. Industrial demand fell, but not residential and kind of other sectoral demand. So that's kind of where you've had that double whammy for gas. Then the cold winter has really exacerbated the kind of shortness or really the tightness that we've seen in Asian inventories. The coal to gas switching And this is really policy mandated, and I think that's where net zero and talks around that do become very, very important. The coal to gas switching has left Chinese demand extremely sensitive to gas. I think this is very much a sign of things to come. China is pursuing a policy of cleaner and greener energy. They've come out with a target for 2060 for net zero, which then means that they are phasing out coal. Now, of course, coal remains their base load. However, they are absolutely starting to push more gas, push more LPG, so cleaner fuels, for both industrial and residential power. So China, and we've seen what China can do for energy markets. We've seen them in oil, and even right now for oil, gas as well. Now they are becoming really the biggest driver. In oil, they surpassed US demand, refining demand last year. In gas now, they have pretty much become the biggest importer, and on a consistent basis. And Japan and Korea, I've touched on, both again have come out with net zero targets for 2050. And you could argue that they are absolutely pushing more renewables, but gas remains a very, very important and a big part of their overall mix, which also then means that if there is coal, then gas absolutely becomes your swing fuel. And there was oil as well. But of course, the baseload demand that you're getting from gas has been very strong. Now, we don't expect prices to stay where they have been at the kind of over December and into January through the rest of the year. We do expect prices, LNG prices and gas prices, to come down. However, I think it's worth noting the point I made about depleted inventories. Inventories have come down so much that usually the way the gas market will work is that the consumption patterns, obviously they pick up in the winter, and then stocking takes place over the summer to prepare for the winter. So a lot of these countries, even Europe, but particularly Asia, is going into the summer net short of anywhere, Japan alone could be short 20 cargoes of LNG going into the summer. So while we do expect LNG prices to come off, like I mentioned, because of the fact that obviously cold weather is dissipating as well, it is worth bearing in mind that the downside will be limited given just how much these countries will have to buy to refill inventories. So in many ways for us, the natural gas market will start to catch a glimpse of the future. So on the one hand, you had a very, very big weather effect. So that's obviously clouding a lot of the kind of short-term dynamics in gas. And that will obviously keep a support, a floor for gas prices. But on the other hand, the green agenda just means that we are bullish on carbon prices. So and the higher the emissions prices, it will certainly support TTF prices in Europe. And I think combined with the need to restock, it just means that we will have higher summer gas prices this year than in the past, even though they come off the current highs. The gas market has also been obviously impacted quite significantly by supply side outages. Now, unlike oil, and I know Daniel's going to talk about quite a bit of this in terms of investment, we are seeing a huge crunch in the upstream oil investment side of things because, oil has become, or had been really for the last couple of years, very much the black sheep of the entire energy complex, right? Nobody wants to get into oil because it's kind of deemed to be not green. Gas was still being considered very much as it's a transition fuel. We will need gas to at least 2050, 2060, then more renewables. But now the push, and particularly from Europe, and I think the COVID has accelerated the push because Western governments are using the green agenda as a way to, or their hope potentially, it will help them get out of COVID by generating jobs and just generating some growth. Now, whether this happens or not, I mean, this is the kind of debate about the Keynesian multiplier effect. I mean, sure, you can put in the money, but let's see whether China and India just come in and take that market share or not. Let's see, well, the jury's still out there. But the focus is very much there. The focus is very much on let's lift these green targets and kind of generate growth via doing that. But in a weird way, by doing that, gas has now also fallen into the oil camp where it's both oil and gas that kind of nobody wants to invest. Now, even so, the if you look at the next 5 years, if you look at our oil database, there's really nothing in the oil pipeline. Yes, OPEC has some spare capacity right now, but once that comes out, and I agree with Paul, the US growth is going to be slow, there's not much left. Whereas on gas, the project pipeline is quite substantial, really, after 2024. But you now have a period between now and 2023 when there's not that much coming online. And last year in particular, we had a lot of supply side reductions, particularly in Australia. Australia was really poorly hit, and some of that are continuing right through this year. There are outages also in Trinidad, of course, in the North Sea as well. So all has not been well for the supply side. And I know oil tends to grab the attention when it comes to supply, but gas has faced a lot of disruptions, which is also going to, and some given the fact that some of these are not going to go away, there will be that level of support even as prices come down. The most important or most interesting thing in a way, and I'm going to spend a little bit of time on this, just bear with me, is Russia. Now, Russia is behaving arguably in a way that nobody's really seen before, because in a market like this, when prices are so high, Russian exports should be rising. And I know what Paul said about Russian cheating, and yes, at the margin they are, but I think Russia hasn't been this compliant, even on the oil side, ever. I mean, they just came out and cut exports for February by like 310,000 barrels per day in oil. Similarly, in gas, one of the really weird things we've seen, and we're still grappling around with it, is that why are Russian deliveries to Europe so low at a time when prices are higher? Gazprom just never behaves like this. Now, there are lots of theories around it. The theories are potentially this is putting pressure because of Nord Stream 2. More and more, it's increasingly likely that US sanctions imposed on Nord Stream 2 will further delay or potentially even prevent the project's completion. Because this is very much about, Angela Merkel is drawing a line under this project, and Biden, of course, the US, Biden's come out even, I think yesterday or day before, very clearly against it. One of them will have to blink. And if Merkel doesn't, maybe Biden just allows it to slip. But yeah, the views are very clear. The US Congress has now passed successive pieces of legislation aimed at this project. And a lot of the companies, which are now non-US companies that have been involved, are being sanctioned. So this is potentially one way of Gazprom telling Europe, if you stop Nord Stream 2, we are going to penalize you, not send you gas when you most need it, by other means or through the other pipelines. That could be one of the reasons. There's potentially the other issue where some of the investment losses in Russia recently have been focused on, or some of the losses have occurred on some of the gas fields, and potentially maybe you're getting some low flows from that. It's not clear. It's quite unclear what exactly is driving Russia. And we are still expecting transit bookings via Ukraine to rise substantially from April. But I mean, I will say this is that if Russian flows remain low, potentially it's politically tied because of Nord Stream 2, then the European gas market does become very tight in the summer, not just relatively tight, like I mentioned, but very tight in the summer. And I think politically, this is going to be very interesting and very important to watch, because gas it's very sensitive, right? You will pass that through to consumers through higher electricity prices, and that's probably not going to be particularly welcome in an environment where growth is weak and unemployment is going to remain pretty high for a while. I've already mentioned this, so I'm not going to go into too much detail over here. Our overall baseload demand for gas is absolutely going to be rising over the course of this year. Yes, we don't necessarily go back industrial demand-wise to 2019 levels till the end of 2022, but overall gas demand absolutely continues to rise. And you can see that it's really ResCom in the second chart over there is that residential heating. And on our models, we factored in. So earlier we had only 5% working from home by 2025. This was pre-COVID. Now that number could be as high as 20 to 30%, obviously very, very biased towards the OECD. In the non-OECD, it will continue business as usual because, again, their work-life setup is very different. But in the US and in Europe, you can absolutely see far more people work from home. So obviously that's going to have a big impact on gas demand. So in terms of where that kind of leaves us with prices, clearly higher prices than we had been expecting. Obviously, first and foremost, driven by cold weather. Secondly, and as importantly, I would say, driven by Russia's behavior and where that plays out, given what Nord Stream 2, well, may or may not end up happening. Now, this, of course, has big implications for shale gas production, right? As much as it has for supplies elsewhere. Supplies elsewhere in gas, much like oil, conventional production takes a long time, simply because the lead times are much higher. But shale can grow, and particularly for gas, what happens on the oil side becomes very important because about 30% plus of the gas production is associated gas from the oil patch. Now, $50 plus WTI, and oil prices have been consistently above $50 for this year. It will mean US associated gas production is going to be supported. But again, over here, Biden's policies do become important. Now, the moratorium or the drilling ban on federal land is less important for this year and next year, because what happens is that most of the producers were expecting this. They've already drilled permits and leases across federal lands, and they are valid for 2 years. So this is not going to have an impact on gas production until mid-2022. So the freezing will really have an impact from basically in 18 months. That's when the US gas market can also get tighter on a relative basis. I mean, we are bearish US prices because there's just a lot of production versus LNG prices. And also only 11% of domestic gas production in the US comes from federal lands, but about 21% comes from crude oil. So on gas, the percentage is even lower. So Appalachia and Haynesville become very critical to balance the market. And the bigger the call there is from the global market on the US market, US gas prices will also have to rise. But on a relative basis, we're absolutely more bullish on LNG prices than we are on US prices. So yeah, like I said, I think US producers will absolutely prioritize completion because capital is tight. I just don't think there is appetite in the financial community to sponsor shale the way we have seen them do in the past, because there just hasn't been positive cash flow. And more producers are being forced to come out and talk about net zero by 2050, and US is the second biggest flarer in the world right now. That is going to be an enormous cost burden on the shale producers, which does mean that shale production, we don't think is necessarily going to go back to the 2019 highs for oil anytime soon, which does mean that your associated gas production is also going to be less. So yeah, with that, I will hand it back to Anthony. Overall, definitely kind of bullish gas view from us in terms of prices, but also, like Paul said, a lot of volatility, especially because one thing I will say about Asia, what they've just been through, they've had to ration power, they've had to have power cuts in the peak of the winter. They're not going to want to repeat this again, and you are going to see a big call on gas demand through the summer.
Rita, thank you very much indeed. That's incredibly insightful. Particularly, I hadn't followed the developments in Russia, so maybe we'll come back to that. If you could stop sharing your screen and then hand straight over to Dan to talk more about sort of power sector issues, then we can then open up some of the Q&A and some very interesting questions coming through already. So please do keep putting them in there.
Thank you very much, Anthony. I will begin very quickly by just illustrating the rather large differential impact thus far, at least in terms of share prices between low carbon ETFs and oil and gas ETFs. We can see a sort of near 280% difference between the beginning of last year, so January 2020, through to the present day. And so we can see straight away that there's a massive difference in terms of how the market is viewing the shares between oil and gas companies and low carbon renewable companies, which is incredibly stark. There are two opposing views really emerging. First, on the left-hand side, we've got the renewable energy optimists, including Lord Brown, essentially expecting peak oil demand to occur earlier with greater returns for those investing in low carbon technologies versus the renewable energy pessimists, the red box on the right-hand side, essentially predicting that depressed oil prices are going to undermine the recent cost competitiveness gains that renewables have achieved. The diagram really just sort of illustrates this by saying that electricity demand and oil demand have declined with oil major revenues and hence share prices declining. We should remember that renewables have priority dispatch on electricity markets in most countries. Therefore, the demand for low carbon electricity has broadly remained unchanged. The commonality between these two views essentially is that demand for oil and by extension oil price is declining. But are we asking the right questions here? The key question that comes up again and again is, are we witnessing demand destruction or demand deferral? In the short term, that's important, but it's also important to consider the impact of depressed prices on investment and the consequences thereof, as well as the fact that renewables don't compete directly with oil. So in the short-term demand forecast, the old sort of crystal ball gazing exercise, Rystad Energy, along with others, have predicted that peak oil demand is going to occur around 3 years earlier, sort of 2027, 2028 time. BP, Shell, Exxon all seem to agree with write-downs of assets between $15 and $20 billion. Principally because oil prices, they believe, are going to remain low for some time. And the IEA, their recent oil market report, have shown that, or are predicting that demand is going to recover by around about 5.5 million barrels per day compared to a decline of 8.8 in 2020. But inventories we've seen are already tightening and prices are recovering a little bit. Short-term demand deferral versus disruption will, of course, become apparent as the vaccine is rolled out. And Paul has already touched upon, changes in working practices and travel. What is clear, though, is that E&P investment has massively declined, a drop, the IEA say, of around about a third compared with 2019. And we need to remember that this is off the back of 2015, 2016 cuts in upstream investment. So that graph on the left-hand side is just showing how dramatically the yellow bar has fallen in 2020 versus 2019. And on the right-hand side, we're just really illustrating that this is not just for the majors, but it's also for the NOCs as well. All have revised down their intended investment over 2020 and beyond. And why is this important? Well, oil price falls in 2014. The capex cuts were mitigated by declines in upstream costs. There was more fat in the system, essentially. So a 40% reduction in nominal spending from 2014 to 2019 only resulted in a 12% reduction in upstream activity because there were cost savings to be had, and indeed, many companies made them. That fat no longer exists in the system, so the scope for cost reductions during the pandemic and going forward is much more limited because those efficiency gains have already been harvested. That means that today's declines in investments are much more likely to directly translate into reductions in activity. And that can be illustrated by this graph on the right-hand side, which is essentially saying the net change due to retirements and additions of infrastructure are massively negative, almost 5% reductions in those net infrastructure change in 2020 relative to 2019. Meanwhile, renewable investments have been much more resilient than in the oil and gas sector. And importantly, renewables will soon start to compete directly with oil demand. And this really could lead to true demand destruction on top of what Paul has already illustrated around changes in working from home and therefore less demand from the travel sector in terms of oil. And it also means a larger electricity market for renewables, because obviously the more EVs you have, the more demand there is for electricity. And this is principally driven by the fact that lithium-ion battery prices continue to decline. Cost parity is widely accepted to occur at about $100 per kilowatt hour in terms of lithium-ion, and that's likely to happen in the next 4 years. So I appreciate this is looking a little bit further beyond this year, but I think it's very important in terms of how investment decisions are made this year and in the near term. And many governments are already increasing their EV targets. They're banning internal combustion engines, and we're seeing much greater ambition, and I'll come on to this in a moment, around COP26 pledges. So the initial diagram that I showed you is maybe a little too short-termist. And what you see here is an adjunct to that initial diagram. In the bottom, we've got much more long-term drivers. So in that green box, we see less CapEx for E&P, and that happens through 2021 as vaccines are rolled out. So the oil market is likely to tighten as demand comes back and supply doesn't come back quite as quickly, leading to oil prices increasing. But at the same time, over the next few years, EVs and batteries massively reduce in price. And then potentially you get this rapid switch towards EVs as consumers, as drivers start really to think long and hard about whether they want to continue driving their old ICE vehicle, and perhaps, and I would proffer that there's this rapid switch to EVs, leading to also greater electricity demand, and therefore you get this significant oil demand destruction over the coming few years. Moving away from that, obviously we've got the US, and I've seen there's a couple of comments in the Q&A already about the US. I'm not going to linger too much on this. I think lots of people know the various different policies of President Biden as he's coming in his new administration. But I think there's two really that I want to highlight. I'm first going to look on the right-hand side at the bottom there. The slim Senate control that they have due to the 50-50 split and the vice president's casting vote means that there's greater scope really for, and I think it needs to be targeted. They're not going to get everything through the Senate, but they can be very strategic in making sure that there's actual real legislative change regarding their climate ambitions, rather than being reliant on those reversible executive orders, which we've seen as Biden has come in. He's dumped lots of Trump's previous policies. And the other one on the left-hand side, I think is really important. And I saw this come up in the Q&A as well. Green trade through carbon border adjustment taxes. Biden has made some positive noises sort of pointing towards this, and this plays in at the same time as the EU is considering it. I think carbon and border adjustment taxes, and just the talk of them through 2021, is going to have a major impact. You know, we've been in a very much a cooperation-driven climate diplomacy and mitigation strategies. Really, I think we could start to see a mix, not a wholesale switch towards a competitive approach to international diplomacy and tackling climate change, but certainly carbon border adjustment taxes are much more of a competitive mechanism to ensure protection of domestic industries and penalise other countries who might be trying to export into your domestic market, but where those trading partners haven't necessarily decarbonised the products that they're exporting into your domestic market. That could have big ramifications, even if carbon border adjustment taxes aren't actually implemented. Just the talk of them could really make the energy transition start to move along much more swiftly. Run up to COP, I'm not going to linger on this one too long. We've already had updating of NDCs. I think there's a real sort of positive buzz amongst at least the NGO community that we're starting to see more ambitious NDC pledges. But separately to this, net zero pledges are coming in thick and fast. And the two of these combined really indicate the directionality of government policy the world over towards an accelerated energy transition and transition more broadly. Last slide here. The problem with net zero, and this is maybe a little bit controversial, but maybe throw a little bit of a cat amongst the pigeons here. This is definitely going to be something for 2022 and beyond, but I would want to highlight that there are lots of problems with the principal negative emission technologies. Obviously, net zero is reliant on there being negative emission technologies or greenhouse gas removals from the atmosphere. There are lots of problems with BECCS and DAC, which are the principal technologies, so bioenergy with carbon capture and storage and direct air capture. I'm not going to run through them, but essentially they're a fairly high-risk strategy. A failure to deliver them in the future and a reduced near-term action as we become more reliant on their future deployment could lead to catastrophic implications for carbon budgets. And there's a greater narrative building that actually, as the bullet points say, GGR might instead deter or delay emissions reductions in the near term. One paper indicating that just the mere thought of them or the prospect of them could lead to temperature rises of up to 1.4 degrees as less action is taken in the near term. And to mitigate that risk, there's a growing call to separate net zero targets out, explicitly dividing them into emission reduction targets and removal targets. Personally, I think this is really, really important because otherwise you have an offsetting of fossil fuels with removals, or the continued use of fossil fuels with removals. In the future, I think this is going to start to move more towards separating out that target, which would then mean hopefully an accelerated transition over the next 18 months or so. With that, I'll just give a very brief summary and then stop. So renewable share prices already outpacing oil majors. Short-term demand declines for oil are unlikely to be the nail in the coffin for oil majors. Demand will slowly return this year, I think, with vaccines being rolled out. But importantly, E&P capex is more likely to translate into larger production declines than in 2014-15. And as that demand returns and production declines, oil price is likely to come back, just as EV ICE cost parity is reached, resulting in a wholesale switch towards EVs over the coming years. And that US re-engagement internationally, green trade is going to be a big game changer, and net zero targets are likely to dominate, but perhaps with a shift towards absolute zero targets as 2022 begins, which I appreciate is somewhat of a controversial view. And with that, I'll stop and hand back to Anthony. Thank you very much.
Great, thanks, Dan. Covered a lot of ground, and I think it's opened up the floor for lots of questions. So we're thank you all for your views on this. I'm going to try and group them. Maybe I'll start with the one that's most upvoted, which is around Saudi Arabia, and it comes from Lucy White. Says, you explain to Paul, but please others join in. You explained that Saudi desperately needs to generate revenues. To what extent do you think Saudi's Vision 2030 plan to diversify economic activities can generate revenue while reducing dependency on oil? So maybe there's that. And then another question for Paul and others, sort of about oil production. If oil prices stay stable or fall, why will US oil production increase if the average break-even is around $40 a barrel? So, Paul, I don't know if you could pick up on those, and Amrita be ready to pick up any thoughts on those.
Okay, let me, can you hear me okay?
Yeah, perfect.
I've been having all sorts of technical problems this morning. The question about whether Mirage 2030, sorry, the Saudi plan is likely to generate revenue as they sort of invest. I think it eventually it will if it works. But the difficulty is that the plan depends upon a lot of activity and investments by the private sector in Saudi Arabia. And the problem there is that the Saudi private sector is feeling quite nervous about what their position is. And so the idea that it's going to generate lots of non-oil revenue, certainly not in the near future. As we go further forward, the more successful it is, the more it is possible that it will begin to generate revenue, but it's going to take it's going to have to go a long way to offset the budgetary problems facing the kingdom.
And the question about the oil price in the United States?
Well, yes, okay. The sort of the estimate, the shale is 40 estimate. If the price stays in the 50s, then there's an incentive there to start production. It's not going to be rapid. It's not going to be very quick, but it will happen, providing the producers are confident that the prices will not fall further. And I think that's a reasonable assumption. I mean, the collapse in oil prices due to the pandemic was due to the pandemic, and therefore I'm quite sure that there's been signs of recovery over the last few months as the prices have begun to rise towards the $50 mark.
Just before handing it, go on. Sorry,
go
carry
on.
No, you finish yours.
I was going to say, it also depends upon what Biden does in terms of the fiscal system and what incentives he may or may not offer in terms of federal taxes, for example. Trump's reform of federal taxes significantly increased the liquidity of a lot of the smaller oil companies. So we'll have to wait and see.
And just before handing over to Dan and Amrit, and in terms of the climate package that he's announced, do you see any impact of that on the short term, or do you think that's much more of a longer term impact in terms of market prices, etc.?
Well, it's not going to have any actual short term impact, other than the way in which it may change expectations. And it could well change expectations, which in turn is likely to change investment decisions. But in terms of the sort of physical supply and demand of oil in the market, this year it's not going to have much impact at all.
Dan, did you want to jump in and then hand over to Amrita?
Yeah, I think I would agree with Paul in terms of the short-term impact of Biden's policies on oil demand in the US. I think it's just also worth remembering in relation to shale and fracking in the US that there's a large amount of drilled and uncompleted wells, which obviously are easier and they're much more flexible to bring online, right? Like you can very quickly respond. So if we remain at $50 and even increase a little bit over this year, they can come online extremely quickly and react to the market.
Amrita, do you have other thoughts?
Yeah, I mean, just kind of taking them each in turn. I completely agree with Paul on the Saudi thing. It's a bit of an if. If you actually look through the details of Vision 2030, quite a few of the ambitions or targets have actually been pushed back again. And digging through this, when we last published on this, it turned out there was a Vision 2020 as well. It was just not as publicized because MBS just wasn't there back then. And look, the reality is that, and Paul's highlighted this in terms of their own budget needs, it's enormous. And MBS's spending, pretty much his own checkbook is just so high. They don't have spending under control. So for them to actually get the private sector to the point where it can become big and generate growth, initially you will need the government to help that. And they just don't have and they're trying, right? Even with Aramco, modernizing Aramco, floating a part of its share. It's all an attempt to get foreign investment into the country. But there's a lot of skepticism, especially after the Khashoggi incident and what happened there. So Vision 2030, yeah, let's see. We remain extremely skeptical. With regards to shale, completely agree with what Daniel said. We've done a lot of pieces on this in detail about completions. I mean, we have employees of ex-employees of shale producers who work in the company, and just kind of and who look at oil production and shale production for both oil and gas in the US. Very clearly, the view is that look, we've got about, and as Daniel said, about 6,000 DUCs in the US. We estimate only about 70 or 80% of those are good quality DUCs, and to maintain production this year. that's where the focus is going to be. There's not going to be new drilling. The rig counts are starting to go up a little bit, but that's not going to be very much the focus. Is absolutely going to be on DUCs. Now, what is interesting in this is that the bulk of the DUCs are in the Permian Basin. It's not a problem. If you do have to run down DUCs to maintain production, even in the likes of the Eagle Ford or the Bakken, then there's a problem. On our estimates, we do run out of good quality DUCs in the Eagle Ford by the middle of this year. So basin by basin, it will differ, and that's when you do need a higher price to incentivize new production and new drilling. I would push back a little bit in assuming that the break even for shale is 40. It used to be. And it was about 45. It has been creeping up a little bit, partly because the service sector has been, it's been pretty much hung to dry, and they have squeezed out every possible penny from the service sector. They can't cut anymore. But particularly, and this is where Biden does become important, is his policies around flaring. The federal land ban is less important, but it is about, if you are going to hit those flaring targets, what are the infrastructures? What's the infrastructure that you need to build out? And that is going to be raising costs. So none of these producers are really looking to grow production. So they'll do everything to maintain production at current levels this year, which is going to still be down year on year on an average basis, even though exit to exit in December is going to be higher. But I think that's really what we are looking at for the US, especially given the fact that you are looking at a hedging profile as well for US oil guys, which are pretty low. It's about 23% hedged. Which usually it's a lot higher as well. So they have been exposed to lower oil prices. So for us, we believe $55 is the new $45 when it comes to TI. Final point on Biden. Agree. Nothing's going to really impact the short term. The thing to watch out for, even more than Biden's policy, is going to be state legislation. A lot more states are going the California route. Even New York recently came out with some measures. And that's going to really start having an impact. And I think the way I would think about it from a market's point of view is that you are not going to take any decision today, whether it comes to refining, whether it comes to just gasoline, diesel investment, without having an eye on that 2030 objective of the state or Biden, because some LCFS particularly, which is kind of the California credit market for carbon, that's becoming hugely important, and that's driving refineries out of business, for instance, in California. Those are the things that are going to become more and more prevalent, and that's how you can have a quote-unquote short-term impact because of those investment decisions. But no, other than that, the CAFE standards, and they're all there. They will just continue to eat away at growth and not really change any of the near-term momentum.
That's great, thank you. Maybe I'm going to take a couple more questions around oil markets, US, and then we maybe move a bit over to some of the climate and renewables issues that have also been brought. So Dr. Yousaf Al-Shamari, I hope that's how I pronounce it correctly. You asked to make a verbal contribution, so please do.
Thank you so much. Thank you so much. Can you hear me?
We can hear you fine, yes.
All right. Well, I enjoyed, in fact, I would like to thank all the panelists and very exciting presentations. I just would like to ask about, my name is Yousaf Al-Shamari, I'm from Sea Markets, and I'm from Saudi Arabia. Regarding the comparison between the Bush and the Obama policy on oil, I just think that, well, because the massive rise in oil production during the Obama administration was mainly due to the excessive rise in oil prices between 2010 and 2014, which has led to the so-called US shale revolution, which is something that has also been advocated by the Bush administration. So I just would like to see the comments from our distinguished professor on that. And another question to Mr. Vadan. There is a lot of common perception that the returning of the United States to the climate Paris Agreement could affect the long-term future of the oil industry. But there's one thing is that Biden will be in office for 4 years. So I just don't know, would any change in the US administration after 4 years could affect the future climate policy and the oil industry? Thank you.
Great, thank you for those questions. Dan, I'd like you to hold your thoughts on that one, because I might group that second part of the question with some of the other climate ones that I'd like to do next, if that's okay. But very interesting question from Mathieu Blondel. He says, do you think the business model of IOCs is more at risk than that of the NOCs in the context of the green recovery and the global energy transition? Which I think is, yeah, excellent question. And then one other, is it expected from Iran to act positively in oil and energy markets as far as the new US administration considers? Does Iran act positively in the market in the Middle East in general? So sort of the role of Iran in oil markets internationally, its impact in terms of the US administration, and then this question about NOCs, IOCs. So Amrita, do you want to kick off with that?
Yeah, sure. Yes, the answer is a simple yes. I think IOCs are far worse affected by the focus on climate change. Shareholders are not giving them an option. I mean, if you listen to CEOs of oil companies, they almost sound like they are CEOs of electricity companies. That's very much the focus. Whereas NOCs, I think, especially Middle Eastern NOCs, whenever I'm speaking with them, and even Russia, they very much believe that oil is here to stay, which I absolutely agree with. Like, oil is not going to go away. Whereas if you look at the, even if growth slows down, but the IOC narrative has to focus on kind of climate change, and it's not an option for them. So IOCs, if you look at the investment profile, and Dan has showed some of this, there is zero investment from IOCs. Exxon may be a little bit of an exception, but if you look at everybody else, there's investment in gas, but everything else is just becoming electricity and renewables. So that's the answer to the first question. In terms of Iran, look, I mean, it's a subjective thing, like whether how they behave in the Middle East. I mean, clearly what you have seen a step up in skirmishes, I would say, in the region, very much to get Biden's attention. What is interesting for us is if you look at what Biden has done, he has pretty much reinstated the JCPOA team in his administration. We understand from our conversations with our contacts in Washington that the US will be rejoining the JCPOA potentially as early as 1st of April, but with the guideline that Iran has to then meet the objectives of basically cutting back on their nuclear program within X number of months. And obviously both parties will have to agree on what that X is. Does that mean you get oil back on the market on 1st of April? No, because they will have to first do these few things that they need to do to comply, and only then can they come back. But it does mean in the second half of the year, we've long believed this, but I think maybe there's an upside to our numbers. There will be Iranian oil back in the market. Remember, not just their production, they are housing about 70 million barrels of crude in China. So a lot of that quote unquote non-OECD inventory that have gone in, and the IEA has just, they really struggle with missing barrels. 70 million barrels of that is Iranian oil stored in China. There's about 30 or so of their own oil floating. All of that oil can come back pretty quickly. Plus, they can probably raise production by 1 million fairly quickly, even if not more. So that oil is there to be brought to the market. But I will say one thing, Iran does have its own elections in April. Rouhani is not allowed to run anymore. He's had 2 terms. Hardliners are very much against this deal, and they are kind of pressing against it. So it's not going to be easy, but do we see Iranian oil back this year? Very much so. I think it's very, very likely we do, but probably more in Q3 rather than earlier than that.
Thank you. Dan, did you want to just jump in, and then before I hand over to Paul?
Just, yeah, super quickly, I'll keep it fairly short and punchy. I agree with Amrita, RE, IOCs versus NOCs. IOCs are under a lot more pressure by their shareholders, obviously. I think, though, an additional consideration is that the renewables market, particularly in the listed space, remains a very new or relatively new market where there's no dominant players. The IOCs do have an opportunity to enter the renewable markets, and the first mover advantage of that is that, be it Shell or BP or whoever who really starts to make that transition, can come in and really start to capitalize on having that first mover advantage. Whereas if the NOCs move later, which, fairly self-evidently they will, they don't have that advantage, that opportunity. So I think, yes, they're under more pressure, but they might also have the opportunity to reap the rewards of being forced into the position of having to transition into the renewable market.
Great, thank you, Dan. Paul, over to you.
I very much agree with what Amrita was saying about the Iranian situation. I would add one thing, however, and that is that the sort of US and the European side will probably demand a degree of renegotiation on some of the issues. And this could well then slow things down quite a bit, as particularly the issue about the Iranian missile program is likely to prove to be a big sticking point. Also, as well, the issue arises, why would the Iranians go back to the agreement? Well, obviously, they would only do so in the hope that sanctions would be removed. But the problem there is that there's a great deal of distrust in Tehran against the Americans. I mean, the Americans unilaterally ripped the agreement up last time, and I think they'll be very cautious about reviving it unless they can definitely see some benefit. And here I can see a typical standoff of saying, well, you remove your sanctions first and we'll come back to the agreements. And the Americans saying, no, you've got to come back to the agreement and then we'll remove the sanctions. As for the NOC-IOC question, this I think is extremely important. The IOCs have a serious problem, and the serious problem is that they've been able to keep their shareholders happy for the last 100 years because they've been very good at creating economic rent and capturing it. And it's that economic rent that has allowed them to pay the shareholders the sort of dividends that they've become used to. Now, the difficulty is a lot of the IOCs are now going into renewables. And the reality is there is no economic rent in renewables. You make money out of it, otherwise people wouldn't be investing in it. But you're not going to make the sort of money that the oil companies have been able to make in the past, not at the moment, as Dan's slide on shares shows, to keep their shareholders happy. And you're going to likely to see a sort of drifting away of shareholders, which threatens the very existence of the IOCs. One small point on the question about the Bush versus Obama one. Yeah, absolutely. It was the shale technology revolution that led to that. But it's very difficult to argue that that had much to do with who was in the White House.
Great, thank you. I'm going to take a couple of questions now. So to build on the second half of the question for Dr. Youssef in terms of the US role, sort of longer term on climate change. There's an interesting question from Lucas. Do you think President Biden will be successful in accelerating the energy transition in the United States? And if not, does that mean that they're more likely to turn his focus to internationally in order to have an impact? So I think that's a very interesting question. And then, Dan, in terms of some of the couple of questions, maybe to you, but others, please do jump in terms of impact of greater renewable penetration in Europe. In particular, we've got quite ambitious plans in terms of the 55% cut in terms of the NDC. What does that mean for oil and gas demand? And then questions around storage. So maybe just expand a bit more the role of storage in terms of, or the importance of it in terms of renewable deployment. So Dan, do you want to kick off with that and then allow the others to join in? And then I'll maybe ask or group some questions together around some of the geopolitics, which I think is, some really good questions on that. So we'll move on to that next and maybe try and finish up with COVID related ones. And I think that's our time done. Dan, so over to you.
Yeah, I mean, just to kind of touch upon Dr. Youssef's second point around the sort of long-termness of Biden's policies, I think Biden's administration has a really big task in order to strategically decide which bits of policy they push through in a legislative manner are the Senate because of that tight margin. There is though that margin to enshrine some of those policies in legislation rather than executive orders. So even if Biden only ends up with one term, the bits of legislation that they do manage to get through the Senate are therefore obviously much more long lasting because they can't be overturned by an executive order. They've got, the next president would have to overturn them legislatively through Congress in totality. So I think that's really important to remember. In terms of domestic versus international, yes, I mean, I think John Kerry just yesterday or the day before was quoted as saying that the US only represents like 10% of the world's emissions or something along those lines, and pointing towards a need to focus internationally to encourage global action. I don't think it's a dichotomy between the two. I think there will be both, and I think Amrita's point before about the let's remember what's happening at the state level is incredibly important. I think Amrita's right. There's going to be more states, whether be it New York or whoever, who follow more of the Californian model. So I think between federal and state level and international action, I think Biden's administration are going to be pushing on all of those levers. In terms of renewables in the EU, yes, high deployments. I mean, if you look at the investments for 2020 across all low carbon sectors, investments in US and China both fell by slightly more than 10% last year, but the EU more than made up for that. So actually overall, I think if I have my numbers right, global investments rose by around about 9%. So the EU made up that slack by the US and China declines. And yes, the EU is moving towards a point of needing to think about balancing on the electricity system in a much more serious way. I'm not sure that that's a 2021 sort of critical consideration, but it will increasingly become so over the coming years. I think one thing to watch in 2021 in this regard is green hydrogen. So I sort of differentiate here between blue and green. Blue obviously being kind of CCS-based hydrogen, so the cracking of natural gas into hydrogen, where you're capturing those CO2 emissions through CCS. Whereas green being electrolysis from surplus renewable power. Just going back over my notes here, there were 90 megawatts of electrolyzers, hydrogen electrolyzers, i.e. blue hydrogen, installed in 2020. BNEF are anticipating that, and I'm very much a big fan of BNEF, of deployment increasing, more than doubling to 240 megawatts. And obviously you get that learning curve. So every time you double your production of anything, doesn't matter whether it's electrolyzers or EV lithium-ion batteries, you pull your cost down that learning curve. So I think hydrogen electrolyzers are due to fall in cost quite considerably. I think it's a really big market to watch, and the more affordable hydrogen that you have in the market, the easier it obviously becomes to balance the electricity system with greater electrification, be that through EVs or heat pumps. And again, heat pumps, there's big growth expectations for 2021. So I think broadly the whole electricity market is going to grow and going to become more difficult to balance. But of course, lithium ion for stationary storage and hydrogen through electrolyzers are coming online, making storage a lot easier. I will pause there and let you bring someone else in.
Great, thanks, Dan. Amrita, do you have any other points to add?
No, I completely agree with what Dan said, and I think
it's a bit boring.
Blue versus green hydrogen is absolutely going to be critical, and especially where, and again, bringing back the IOCs as well, right, where they choose to invest, and just tying it together. I mean, IOCs, and this is why IOCs have struggled in shale as well. What is their comparative advantage in renewables or even in hydrogen, for instance? That's why you see the likes of BP going and buying companies, right? I think that's exactly what you're going to see. But yeah, lots of questions around this and the deployment as well. But no, I couldn't agree more with what Dan just said.
Paul, anything else to add?
No, the only comment I would make is remember that if you go back 10 or 15 years, top of the pops was CCS, and everybody was talking about CCS and getting very excited about CCS. Now it's hydrogen. Everyone's getting very excited about hydrogen. These things come and go depending on the fashion. I mean, in the longer term, certainly, and particularly the green hydrogen. I think the blue hydrogen is going to have limitations.
Anthony, just one point, because Paul mentioned CCS. Offsets, I think, will be very interesting, and in the context of climate change, and I think that's going to be something we should focus on and kind of where it's heading. US companies, shale companies particularly, are actually focusing on CCS and CCUS to try and do the offsets. And it's interesting that they are choosing that path versus potentially what the European majors are choosing. So it's interesting to see the divergence in strategy there.
Can I just jump in really quickly on offsets? I've got a bit of a bee in my bonnet about offsets at the moment, I'm afraid. I agree with Amrita that offsetting is going to be a big theme for 2021. Obviously, Mark Carney and others are pushing big on offsetting. Boris Johnson, British Prime Minister, made the comment recently that I think he wants to expand offsetting to the whole of the, carbon markets to the whole of the UK economy. Let's not kid ourselves. There's a huge risk in offsetting of double counting. There's a real problem with MRV, monitoring, reporting, and verification. We need to ensure that any carbon offsetting actually results in real reductions and an equivalent amount of reductions. That doesn't always happen. You only have to look at the likes of Ryanair and their ability, and there are other airlines who do that as well. I'm not just focusing on Ryanair. There's real problems around the kind of greenwashing of offsetting. We need to make sure that MRV is done correctly. We need to make sure that any issues around permanence are resolved. So planting a tree this year to enable someone to fly or to feel good about flying, we need to make sure that that tree actually stays in the ground over the long term. Otherwise, offsetting is really just going to result in us making us feel better about ourselves and a large explosion in markets, people making a lot of money, but no real scientific change to the conundrum of carbon budget.
Thanks, Dan. I'd just like to use my position as chair, just thing to add in terms of the European renewables. It's important to note, and I think it will be an interesting lesson to follow, or thing to follow, is obviously the EU has increased its NDC from at least 40% to at least 55%. So that's the target of emissions reductions by 2030. We're yet to see what that means for the different sectors in detail. So for example, on renewables, where they had a target of at least 32%, as it's gone up, what does that mean? And if we're then talking renewables contributing 40–50% of energy across the EU power sector, this is very large percentage. So I could imagine that we will start to see rolling out, or what I hope to see this year at least, is we've got the NDC, the net zero targets, we've got the NDCs, and then how do these actually implement on different sectors will be really giving us a clear indication of direction for renewables, storage, etc. So yeah, exciting times in that way. So we've got 4 minutes, because I said we'd finish slightly before because everyone's got other meetings. So I'm going to offer our panelists a sort of 1 minute each in terms of some of the geopolitics. How do we think the changes will affect? There's a few in terms of China, in terms of Middle East, etc. Are there something big that we should watch in relation to COVID and energy and climate change that we haven't touched upon already? So yeah, Paul, you can have the first impossible task of your thoughts in this area.
Yeah, in 1 minute. I think we're going to see an improvement of relations between the US and China with Biden in the White House. And I think that's important because one of my fears was that we would see increasing international trade wars, and that would tend to deepen and lengthen any sort of recession. I think another interesting thing to watch will be the relationship between Washington and Moscow, to see to what extent the US starts to take action against Russia in sort of the terms of sanctions particularly, and what Russia's response to that will be. And thirdly, I think, again, the relationship between Washington and Riyadh, I think, is going to be extremely important in terms of how Saudi Arabia decides it's going to behave in the oil market. So those are the three things I would think to watch this year.
Perfect, very succinct. Amrita.
Similar to Paul, I would start with the US-Russia one. I do think that's kind of brewing. And it hasn't quite been dealt with. Obviously, I spoke about Nord Stream 2. I think that's going to be very critical, and we'll probably hear more about that this year than we have in the past 4 years because of obvious relationships. I don't think US-China will change very much in the sense that actually the Democrats have pretty much the same beef with China as the Trump administration have had. That's one of the only places they agreed on. But I think for me, the Russia angle, potentially what he does in Venezuela is going to be important for oil, but I don't necessarily see a big change there. But particularly what Paul said for the Middle East is going to be critical for oil, because clearly the pro-Saudi, anti-Iran rhetoric over the last 4 years is going to be completely unwounded this year. Final point, I would say, not geopol, but kind of broad politics. I think with Biden coming back into Paris and kind of the US's focus on climate change, I think this has huge geopolitical ramifications for oil and gas producers. Like, think about a Russia who's not even focusing or even talking about a net zero. I mean, there are going to be winners and losers in this, in African producers as well. I mean, there's a lot of, there's a huge revenue need for them anyways, from oil and gas to just keep their economy going. And now if they have now start investing in low carbon means of growing production, I think as an industry overall, we do underestimate what net zero means for the oil producers. I think it tends to focus a lot more from the consumer side.
Very clear, thank you. Dan.
Yeah, I think I broadly agree with Amrita and Paul. Unfortunately, I think Nord Stream 2 is going to be really important. I do think, though, it's worth bearing in mind that probably macro scale geopolitics is going to be increasingly dominated by vaccine diplomacy this year, to the detriment of other issues. I suppose in terms of energy, the energy transition, I think sort of setting aside the geopolitics of oil and fossil fuels, I think border adjustment taxes are going to shape things. Border adjustment taxes are not going to be implemented anytime soon. It's going to take a long time to work through how do you implement BATs in terms of WTO rules, etc. But I think that the more that is discussed at a high level as to how do we implement BATs, in line with WTO rules, and the more seriously that the markets see that politicians are taking BATs, because it's going to be just discussion this year, I think that is going to have a real implication. It's also going to have a real implication for dragging along those countries, maybe Russia is a good example, where they haven't really sort of decarbonised to any real great extent at all. I think as we move through the year, that discussion around BATs is going to play into, okay, COP26, some nice ambitious NDC pledges. How do we translate them into implementation? What does that look like in the real world? And that BATs discussion will play in. I think the other part of that is recovery packages. If countries start seeing that recovery packages by countries are really targeted at low carbon sectors, that is also going to play into that BATs discussion, because BATs really are going to be targeted at your trading partners who you think aren't putting in the effort to decarbonize or who haven't decarbonized. And recovery packages are going to be the big signal to trading partners as to real intention to decarbonize, and those trade-offs for politicians around where those recovery packages are targeted is going to be an unenviable task.
Thank you all very much indeed. We're just about time. I really appreciate your thoughts and your contributions. Thank you very much for the audience. Most people have stayed, and we've got through a lot of the questions, not quite all, but maybe we can pick some of these up at future discussions. Do stay in contact with us. Look at the website. There's many other online discussions over the coming year. It's obviously going to be a very important year. Geopolitics has changed in terms of the Biden administration, as Dan said, in terms of the green recovery. and of course, COP26. And we will be following all of these. So yeah, please do stay with us. And thank you all very much indeed. Have a good afternoon and a good evening and a good morning, wherever you are.